despite a volatile start to the year and continuing tariff uncertainty, large cap stocks have performed relatively well. Our next guest says that the market has recovered as if nothing has changed. We're navigating how to play large caps with the Yahoo Finance playbook. Joining us now, Brad Klapmeyer, Senior Portfolio Manager from the Macquarie Large Cap Growth Team. He manages the Macquarie Focused Large Growth ETF with $220 million in assets under management. So not just large cap, but large cap growth specifically, Brad. It's good to see you. Thanks for being here.
Good to see you too. Yeah.
So I would ask you first of all about the round trip that the markets have taken, right? The big dip on tariffs, the comeback from tariffs. Now we're pretty much flat on the year, more or less. That's kind of true for large cap growth also.
Yeah.
Should that have been the trajectory? What is the market factoring in the full picture, I guess?
Yeah, unfortunately, I don't get to decide the trajectory, but I can analyze it. And I think what we've seen is investors coming back to the same playbook that they've been familiar with since November 2008 when we started quantitative easing, is that whenever there's some dispute or disagreement, you just buy the dip. Something will go the right way of the market. And unfortunately, what I believe is that's no longer the case. We had from November 2008 to really March of 2022 when we started quantitative easing, where I think the rule book has changed. We had zero rate policy going to higher rates. We had no inflation, a Goldilocks inflationary scenario going to now a sort of anchored, embedded inflation. We had globalization now going to isolationism, and we're still trying to play that playbook that we had over the last 15 plus years. I think that's dangerous territory. So what I would say is, yeah, we had this emotion that pulled the market lower, and we had emotion that pulled the market up. Expect that for the next 5 years at least, is what I would say. There's going to be a lot of chop.
So you would actually define, Brad, did I read this right? You would define the market as super risky here? Talk me through that.
Yeah. I think from a super risky standpoint, it goes back to that narrative I just presented, where I think, 12 or 15 years ago, coming out of global financial crisis, valuations were very attractive in the market broadly. And so I would say at that time, if you had $1 to spend, put it in the market. I think that's why passive ETFs became so popular. Just invest $1 and to get it in the market. And unfortunately, we've kind of squeezed all the good out of that. And now valuations are pretty rich. Broadly, I think, and for growth stocks. So how we're handling that is we're using valuation discipline. We're putting quality before growth. We're just using a lot of discretion. I think just blindly throwing market money into a sort of concentrated market is just risky at this point.
Well, it's interesting because I look at some of your top holdings, and we got, 5 of the 7 in those are the top holdings: Microsoft, NVIDIA, Apple, Amazon, and Alphabet, which I think you can argue, given earnings outlook, that the valuations aren't all rich. But I am curious why that, large cap growth, you only have so many choices. I understand that.
Yep.
But why sort of go into that concentration that's pretty close to what we see, for example, in the S&P 500?
Yeah, no, I think that's right. I think the first deciding factor is we have to decide, how do these companies get to this size of market cap? Like, do they deserve it? And we would say most of the Magnificent Seven do. We have disputes about the quality of the business with like a Tesla. We don't have a position in Tesla. We think it's an automotive company with a software layer, not a technology company that happens to make cars. So we're not interested in paying wild valuations for it. But I think a lot of these Magnificent Seven got there because these are some of the most phenomenal businesses we've ever seen. The risk now, and why we have taken different views of the quality of those businesses now, is that they're all highly correlated to one thematic. And that thematic is cloud compute and AI. So we're not thrown off by the fact that the market is concentrated, but we call it blind concentration into thematic versus what we're trying to do with the Macquarie Focus product is do intentional concentration, really think through how a portfolio comes together. We don't want to give an investor a beta portfolio or AI thematic portfolio if they're trying to invest in a quality growth portfolio. And to me, that describes this risk in the market. All of a sudden, we ended up with a group of great names. That's right, but the fact is they're all highly correlated to a single thematic. That's risky, and I think people need to really think through the process of what they own in their passive investments.
So there is risk, Brad, but I know you think there's also opportunity.
Yep.
High level, broadly, I know one area you continue to like, data center REITs.
Right.
How come?
Yeah, I think you have to be careful with the REITs, first of all. There's not a lot of differentiation in sort of the retail REITs. They're very popular right now because we're obviously expanding the capacity that we need for compute. The name that we think is just exceptional quality in the REIT space is a company called Equinix, EQIX. And the reason why we like it is they just have the most phenomenal locations in the world. They have what's called cross connects and interconnects. So if, let's just say you're Nike and you want to connect with the Salesforce platform, you want to be in a location together so you can have that low latency. You can speed it up. You have this privacy to it. And believe it or not, that's called the network effect. If you can get all these wonderful businesses in the same location and they're all cross-connecting to each other, no one's going to jump ship and move to across the street. It's just impossible. So we love the network effects here. And I think what we're going to find, this is our hope and why we like the business, is they're going to take that advantage of locations and what they're doing with those cross-connects. And as some of these AI training models get put into production, same thing, you want low latency, you want to be on the edge, you want to be connected with your partners, and we think they have a real competitive advantage to really emphasize their value as we move into productive AI.
Brad, great to see you today, especially on set. Thanks for coming in.
Yeah, thank you.